The yield on the benchmark US government 10-year bond, one of the most watched financial assets on the planet, staged a 10.37 basis drop to 2.19% following the announcement, the sixth biggest move this year. Saxo Bank's Simon Fastel, speaking on thetradingfloor.com, thinks the dovishness from the Fed suggests the market is set for further strong performances.
So this reaction in the bond markets are obviously a strong performance in most bonds. We see lower yields in US Treasuries, German bonds, and also other government bonds from Europe. So what is the preferred strategy from here? Well, I believe that all spread over products, that will say high yielding bonds and especially emerging market bonds, should perform from here. It will take some time, but as market begins to realize that Fed actually is more dovish than we have seen, I don't believe we see a Fed hike. Not even in December. I believe it's postponed to next year. Then we will start to see performance in these spread over products, also EM bonds.
Wealth manager Jonathan Davis thinks that a lot of big buyers are confident of no interest rate moves for some time, and bonds will do well as a result.
Government bonds rose sharply in the US, they rose sharply in London, and on very large volumes. In other words, there are big players out there building big positions, and yes, we are very comfortable indeed that our clients are invested in government bonds.
This is a view Jonathan has held for some time due to the stability of bonds during China's recent volatility.
We at Jonathan Davis Wealth Management have been heavily invested in government bonds. And we continue to be so just after the equity markets had a significant wobble in August. I said it's something to watch out that bonds didn't rally hard while stocks fell significantly. And that was certainly a question. However, there is no question in our mind now. We listened carefully to the chairman of the Federal Reserve, Janet Yellen. We listened to the chief economist of the Bank of England, Andrew Haldane. Both of them have said absolutely clearly that we are in an era of disinflation and probably deflation. As it happens, we've been saying it for years.
Jonathan thinks the situation will continue due to the unlikeliness of a significant interest rate rise.
Over the next few years, each individual decision point will be a coin toss. The point is, they could still raise at some time in the future, but this is the main point I want to say. Whether or not there is a rate rise, a couple of rate rises, we are very probably, if not now, definitely turning Japanese, as I've coined on Twitter. Japan, as you know, went through over 2 decades of very low inflation, indeed effectively deflation. And we have had now several years of effectively zero interest rates, and our inflation is literally 0.0%. We are in an era of disinflation, falling inflation, and possibly even deflation. An era, not a summer, an era. In that scenario, you can basically take it as read that we will have very low, if not zero interest rates for as long as you can imagine.
As a result, Saxo Bank's Simon Fastel believes bonds are a safer bet right now than stocks.
I prefer at the moment bonds to stocks because we could see some sideways move in equities from here. In European equities, quite bearish start because now it is the growth uncertainty and also the stronger euro that is a problem for the European equities.
The outlook on an interest rate rise is still far from certain, however. Traders surveyed by Bloomberg now see a 46% chance the Fed will raise rates by December, while 20% are still expecting a move to come as soon as October.